You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overbeat, Ally Invest Senior Options Analyst and author of The Options Playbook. All right. Well, we tried to get bearish on the market last week, and we looked at one of the meme stocks, AMC. It seems like the apes are still hanging around, even though we had a little bit of a rough time last week. AMC managed to hold its own. We did look at a long put spread, and we talked a lot about the fact that if I were to trade bearish trades or even bullish trades in the meme stocks, a lot of times we're going to be leaning towards doing spreads. So we did a long put spread, which meant we bought a little bit in the money put and sold a little bit further out of the money put. Managed our risk by doing that trade. And it's one of those trades that if you're doing this and you're speculating on a movement in a stock like AMC, that you want to have that risk defined. And you basically, to me, it's an all or nothing type trade. Either I'm going to make close to the maximum or I'm going to lose close to the maximum. And that's the way that I would still approach it on AMC. So let me go back and we're going to rehash that. And then our theme today is going to be bottom picking. And this theme this week on our Ally YouTube channel, I did what we call the stock play of the day. We do that every Tuesday at noon live on the Ally YouTube channel. And I looked at picking a bottom in Pfizer on our stock play of the day. And how did we do that? We were selling some puts in Pfizer, trading at about 10 times earnings. If you're thinking about a recessionary type scenario, Pfizer obviously is a well-known stock, one of the leading pharmaceuticals. And if you're trying to bottom fish, that's a strategy that you might use. And that's what Options Playbook is all about. We're just looking at strategies that will fit what's going on in the marketplace. It's not necessarily about making recommendations on this stock or that stock. We just want to give you ideas on the stocks that you like to trade. And if you're thinking of bottom fishing, this is a strategy that we can use. We haven't talked about cash secured put selling in a long time. And it's mainly because prior to the downturn, the markets were just going up, and selling cash secured puts left a lot on the table because the maximum you can make is the premium that you paid for it. And if the markets are going straight up, you would never really get that opportunity to buy that stock at that lower price. And that's the concept of a cash secured put. Well, I'm getting too far down the road here on the strategy that we're going to talk about today. So let's go back and let's look at what's happened in AMC, and I'll talk a little bit about that trade from last week. Well, when we put the trade on, the markets were closing. It was June 22nd. The stock was at 1252 at the time that we were looking at the trade. We bought a little bit in the money put with a July 8th expiration. So we gave it some time, and part of the rationale was we wanted to go over the July 4th holiday. Hopefully some of the apes might be out enjoying their 4th of July and not be driving the stock up. So that was a little bit of just playing around a little bit, just like, that we're doing this on paper. That was a very speculative trade. So we bought the 13 strike put, which is a little bit in the money, and then we sold the 11 strike put. But more importantly, we did a 2-point wide spread, and our goal was to get it done for around $1. We wanted to have just as much upside as we had downside on the trade. When I took my screenshot of the trade from last week, it was actually trading at a midpoint of 97 cents, and it was a tight market, a fairly tight market. So I'm pretty sure you could fill somewhere close to the midpoint. It's never a guarantee. That means that for every 1-by-1 spread, we are risking $97 plus commission on that trade. And for a moment, it looked like the trade was doing well. We had I think the next day was a down day in the S&P 500 index, and we actually saw AMC come down and touch the 1150 level, looking pretty good. Now it's at 1365. So the market came back, and not only came back to where we started, it's actually up approximately a little over a point since we put the trade on. So the trade is still doing okay. And the concept, like I said, was we risked $1. We knew we were risking, 97 cents. And we knew that that was our risk. And we still have obviously opportunity in this underlying stock for that stock to go down and hopefully finish below that $11 range by July 8th. Now, with that said, on the 23rd, the very next day is when we hit that 1150 level. Now, we did not hit the 11 strike. So in my mind, I just want to be very brutally honest with this. I would not have gotten out of the trade. It didn't hang in that range very long. We didn't have a lot of time decay. There wasn't a volatility crunch. The volatilities kind of stayed right where they were at, the implied volatilities of the option contract. So I would not have gotten out of that trade. And I still wouldn't get out of the trade right now, even with the stock at 1365. And with that said, I should mention that we are taping Options Playbook Radio on Wednesday, the 29th, and the markets are closed right now. So the market is not moving. It was up 27 cents today, which was about 2% on AMC. So a fairly strong move in a weak fundamental stock today, AMC. So I would just stay the course. You could think about rolling it into put butterfly, but I'm just not there on this one. I think it was a completely speculative trade. Let it ride. Move on to the next one. All right. So now we're going to change themes. We're going to go from completely speculative strategy from last week, and this week we're going to look at bottom fishing. And I just think the timing is right. We're officially in a bear market. Nobody really knows exactly where we're going to next. They keep talking about recession, but unemployment is still low. We had actually some good housing data come out this week. And with all that said, the consumer is still strong. I guess is if you're going to sum it up in one instance and say what is keeping us afloat and why we're not necessarily in that recession, is that the consumer is still strong. There's still some buying power there from the consumer. The inflation hasn't eroded the consumer's want to buy things at this point in time. Okay. So I want you to check out the stock that I was a little bit more interested in bottom fishing on was Pfizer on Tuesday, stock play of the day, looking at a low PE on a solid company. Usually a lot of the healthcare companies, pharmaceutical companies are recession proof. So if you're trying to bottom fish, that kind of makes sense to do a strong fundamental company. But with that said, guess what? Amazon's been beaten up too. And it's a $108 stock now. Well, today it's closer to $109. But well, why not think about a cash secured put in Amazon? Now that it's gone through its 20-for-1 split and it's feasible to buy 100 shares of stock now in Amazon. Well, let's consider it. It's still trading at a much higher PE, but it always has, Amazon has always traded at a higher PE. Retail customers still strong. They obviously have their cloud business, which is extremely strong. There are a couple of Microsoft is making a little bit of a dent in their business model, but Amazon is obviously not going to zero anytime soon. I think I'm safe by saying that. So let's think about Amazon. If I'm willing to buy 100 shares, and we did a couple of these trades. We looked at Ollie's after the bad news in Target a few options playbook radios ago, and Ollie's has done extremely well. And in Ollie's, we looked at a short put spread. And it's mainly because in Ollie's, the implied volatilities were much higher than they will be in Amazon, which we're going to look at today. And I just, in a stock like that, which has, they have a lot of cash. The Target news made Ollie's interesting. And there might be some people that don't even know that underlying stock, but it's a very big bargain outlet here in the Carolinas where I live. And basically throughout the South, but they have a lot of cash on hand. And when there's excess inventories, they like to buy them up. Retailers, bigger retailers like Target and Walmart, they know that if they go to Ollie's, they're going to get a cash offer for some of that inventory that they want to get rid of. And the stock is actually up quite a bit. It's up around 15% since we talked about that underlying stock, which just in general, in a weak market, it's doing pretty well. All right. So instead of the cash secured put, I'm saying that if you are legitimately thinking about a stock like Amazon, well, why not do a little bottom fishing? It's still trading at a fairly high PE, but if you're willing to buy it at a lower price and you have the cash to do it, this is a strategy that you can do in a retirement account, in an IRA account. So I'm just going to go out and I'm going to do this short term. I don't want to go out way far on this trade. We're even though implied volatilities aren't extremely high, it's trading around a 44% implied volatility on the at-the-money option contracts in the expiration that we're going to use, which is going to be the July 8th expiration, 9 days away. But if I look at Amazon and I think about, well, what's the potential move? Like I said, the stock's right around 109. If I looked at the at-the-money straddle, buying the call, buying the put, it's right around $6. Well, you know what? If it makes that move to the downside, maybe I'd be willing to buy 100 shares. That means that I'm going to have the strike price plus 100 times 100 shares, that type of capital in my account, if I truly want to do it on a cash secured basis, meaning I'm intending to buy that underlying stock. So if we go down to if we look at the 103 strike, that 103 strike on that July 8th expiration, we see that is currently trading at 107 by 111. All right. So it's a fairly tight market. So markets are closed. I would assume that I could sell somewhere close to that. I guess for just to make things simple, we'll say 110. Markets aren't open. I can't guarantee that type of price, right? Because it's a little bit closer to the ask, but it makes the math simple. So we're talking about $110 less commission to say that I will buy Amazon over out until July 8th over the next 9 days. If it makes the expected move to the downside, and that means I have to have $10,300 in my account, and I could do this in a retirement account as long as you got the proper approvals to be able to buy that stock if it is put to me at that price. And my goal with Amazon, if I'm doing this, I'm not spreading it. I'm literally bottom fishing it because I'm saying to myself, I'm not speculating like we were on Ollie's on a little bit, lesser known stock, right? I am literally saying I really want to buy it. So if it comes down, I don't want to buy that protection below and spend some of this premium. First of all, I'm not getting as much premium as I would in a stock like Ollie's, and I want the stock. So the concept would be if you were trading a stock like Amazon and you were trying to bottom fish, if this one expired worthless, I would just do it again, and I would do it again, and I would do it again until I got my 100 shares. And that's the way that I would approach it if I'm looking at it. And then if I do buy it, and I'm still, it obviously depends on the environment. One of the more common things that a lot of people that are put sellers willing to buy stocks is just looking at selling a call against it in the short term, lowering that cost basis again. But you want to be we're coming into earnings season. I don't really want to do it around earnings season, right? So I want to be very cautious on the calls that I'm selling, but it all depends on where we're at when we actually get put the stock. So very straightforward strategy. Our risk would be that we would be put the stock at 103, $6 lower than where it's currently trading. And then also a risk would be that if you didn't have the capital and you're not doing it truly cash secured, there's a lot more risk in the short term on the downside on the stock like Amazon. So very straightforward trade. We're going to look at a few more of these just with the fact that we're officially in the bear market, trying to pick bottoms on stocks that you may like to buy. And we started with Ollie's. We're looking at Amazon today. And guess what? That's going to be it for this episode of Options Playbook Radio. If you have a topic that you would like us to discuss on the show, please email them to me at theoptionsguy@invest.li.com. Please follow me on Twitter. I tweet about all the educational events that we do at Ally Invest. My handle is quite simply at Brian Overby. Thanks for listening. We'll be back the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.